Yes, people, how are we all doing? So, welcome back to another trade breakdown showing off the Samurai strategy. This is a trade that we took yesterday on the New Zealand dollar, US dollar, otherwise known as NU. So, let me run through all the confluences that we took for the trade and how it played out. So, first of all, we mark out the Asian session, which right now is from 1 a.m. to 7 a.m. The way to plot the Asian session is it's the overlap between the Tokyo and the Sydney session. The overlap of those two sessions gives you the Asian session. So, first of all, we wait for that to finish, and then we see how it plays out. So, now that the Asian session has finished on this chart, what we're doing is we're waiting for this high or this low to get swept, first and foremost. But we don't just do this on any old Asian session. We need the Asian session to be an accumulation. And the way that we mechanically define that is if the high and the low doesn't come from either the first or the last candle. So here we've got clear highs and lows, just like that. So this is now a valid Asian session for us to trade. Then, second of all, once the Asian session finishes and we have that high and low, we're waiting for either this high or this low to get swept. And the reason that is because the high of the session and the low of the session is where a lot of liquidity is resting due to there being stop orders. Now, what do I mean by stop orders? Let me get rid of this full screen because I keep pressing escape to get rid of the arrow and it keeps fucking minimizing my screen. Okay, so what do I mean by stop orders? So let's say you got in a sell position there, okay? Most people are going to have their stop loss either at the high or above their high and maybe target a low down here, okay? Other people that would be looking to go long, let's say they were trying to trade this from a breakout, they would have their buy stop somewhere above that high. I don't know, maybe they'd have their low like a few ticks below here and they might be targeting, let's just say, a fixed 3R, for example, just to make this nice and simple and basic. So those would be two instances of stop orders. You've got stop losses and then you've got buy stops. So for the people that are short at this current moment in time, if price takes out this level, they lose and that pours money into the market. And for people that are looking to go long, this move would tag them in, okay? So they would then be tagged in from this move. And the way that would get manipulated and make them lose is if price came back down here. In that scenario, this causes the maximum amount of damage to retail traders. When highs of sessions and lows of sessions get swept, taking out both sides and then reversing. This is manipulation. So when we talk about AMD and the power of three, which you probably have heard of, if not, I'm going to teach you. So the maximum amount of damage to retail traders comes when you have an accumulating range, usually a session, a manipulation move like this, and then finally a distribution. Because this pours money into the markets, and money into the markets means that it's more liquid. It means that buyers and sellers can exchange orders for one another smoothly without there being any gaps in price, and then usually this would then power the move. So I was not going to use these arrows, but here I am. So that basically describes AMD, and it's where you have, plain and simply, an accumulation, manipulation, and then a distribution. So that is the classic AMD model, and that's what we trade here. So let me get rid of all of that and show you what happened. So we have our Asian session which accumulated. Wait for price to take out either a high or a low. Came close, but it didn't actually take out that high. So there was no liquidity swept. But now finally, we have this low that got swept. So let me mark out that low. And you see here, liquidity got swept. So here you can see anyone's stop loss that was there would have been tapped out. Any buy stops that were trying to break out that level on a sell stop would have been tagged in, and then price reverse and tap them out. So let me show you that once again. Let's say you caught a buy here after this candle and you had your stop loss down there, targeting something up there, and let's say you were trying to trade the breakout of that with a stop order, a sell stop there, maybe SL a few pips that way, TP somewhere down there. So there you can see this move of this low getting swept and reversed causes the maximum amount of damage to retail traders, and it pours the most amount of money back into the markets. And this is what the market makers want to do intentionally. They want to pour money into the markets so that they can flow more smoothly. Otherwise, you don't have a zero-sum game. Every order needs a seller in order to buy it, and every buyer needs a seller in order to buy it from them, vice versa. I don't know if I got that right off the top of my head, but you get the picture. Every buyer needs a seller, every seller needs a buyer. So they will manipulate the markets and move the markets in certain ways so that that happens. But when you learn to read that and read those moves, you can play against them. So we waited for these lows to get swept, just like that. And then what we wait for, step 2, is a previous high to get taken out like this. And this is what gives us our change of character. So we wait for that confirmation of this low has been taken out, and now this candle close above this last high is suggesting to us that the distribution is about to take place. So then, after that close, what do? We plot a Fibonacci tool from the last significant low to the last significant high, just like this. And then we wait for price to come back to the 61.8 fib, SL at the previous low, and our TP is at the 61.8 extension level. And this gives us, in this case, a 3.2R trade. This then becomes a buy limit. And what we're waiting on is a slight pullback from that displacing move to tap us in here and push up here. Now, remember, this isn't always the case. Trading isn't a game of if this happens, then this. You can never be 100% sure with any move in the market, and anyone that claims that they know for definite what's going to happen next is an absolute idiot. There's a reason. If anyone ever says that, then just tell them why do you have a stop loss? If you know it's going to hit there, then there, why do you have a stop loss on? The reason you have a stop loss is to account for the fact that you could be wrong. And if you are wrong, you want to know how wrong you are, okay? So in this case, if we're wrong, we're only 1% down. And that's a small controlled size bet that we can afford to take. This strategy in general has around a 40% win rate. So when we lose 1%. But when we win, we make like 3.2%, sometimes 3.3%. So on a sample size of 100 trades, we only win 40 of them and we lose 60 of them. The 60 that we lose 60%, but the 40 that we win 120%. So after 100 trades, we're still 60% up because it's 120 minus 60. Okay, so that's the edge that you play on the markets with a strategy like this.